Everyone, let's get started. Thank you very much for joining us. My name is Pat Somerville, Senior Partner and Co-President here at Hamilton ETFs. And we're excited to once again have prominent Wall Street strategist Ed Yardeni here with us for a timely update. An update from our last discussion in early April when the stock market had actually just suffered a major correction following the tariff announcements, and it really looked like the world was falling apart. Obviously, since then, markets have staged a pretty powerful rally. So we thought this would be a good time to check in with Ed and get his thoughts on where he sees things going from here. But before we go into that Q&A, I just want to provide a quick update on our firm. We continue to be one of the fastest growing ETF managers in Canada. And I just want to put this growth into context. 5 years ago, our AUM was approximately 200 million. Today, we're 40 times larger, or approximately 40 times larger, with about 8.2 billion in AUM. That's now spread across 4 distinct categories of ETFs. This growth, I would say, not only reflects the strength of our team, but also the confidence that investors like you have in us. And I just want to say on behalf of everyone here at Hamilton ETFs, we appreciate the ongoing support. And we remain focused on delivering innovative ideas to help investors get more from their portfolios. And in fact, we actually will have a press release coming out at 5 p.m. today, so stay tuned to our website announcing the launch of a new suite of ETFs that we're quite excited about. So stay tuned for that. So just very briefly, I just want to quickly go over the 4 distinct categories of ETFs that we have here at Hamilton ETFs, each designed for different investor needs. As many of you know, we are one of the largest providers of Canadian bank and financial sector ETFs. We're also one of the largest, and we are the first provider of enhanced ETFs in Canada, where we utilize modest leverage of 25%, providing investors the potential for higher long-term growth. And then over the last few years, we've also become one of the largest covered call providers. This has been about a 4-year time period with our popular suite of yield maximizer ETFs that are really designed for income investors that are seeking higher tax-efficient yields from virtually every North American sector, which also includes fixed income. And then finally, just a few months ago, actually back in January, we launched the Hamilton Champion suite of ETFs, which provide low-cost exposure to blue-chip Canadian and U.S. equities. So here on this next slide that I want to show everyone, I'll introduce you to our 4 Champions ETFs that really are designed to provide a disciplined approach to dividend growth investing. We focus on blue chip companies with proven long-term track records of increasing and sustaining dividends across economic cycles. On the bottom left, you can see what we call the MVPs. We have the Hamilton Champions Canadian Index ETF, ticker CMVP, and we have the Hamilton Champions US Dividend Index ETF, ticker SMVP. Both of these come with a 0% management fee through until January 2026, after which it will reset to a highly competitive 19 basis point fee thereafter, making these very cost-efficient core equity holdings for investors to consider. And then on the bottom right of this slide, you can see what we like to call the winners. The tickers are CWIN and SWIN. Essentially, these are enhanced versions of the MVPs that I just highlighted, and they utilize modest leverage at 25% to provide a bit more growth potential over the long term. So effectively, what you have with this suite is you have 4 Champions ETFs where you can choose your playing style, call it, where you can get low-cost core equity exposure with the MVPs or higher growth potential from what we call the winners, CWIN and SWIN. So just very briefly, we'll just talk about some performance characteristics of the indices that these MVPs track. So this shows the Selective Dividend Elite Champions indices. Here on this slide, you can see the Canadian Dividend Elite Index has displayed material long-term outperformance versus the TSX 60 by approximately 200 basis points. That's compounded annually going all the way back to 2006, so quite a good number. The gold line on this chart just shows you the cumulative long-term impact that compounding would have with modest leverage at 25%. And then similar story, just not to the same magnitude here with our US Champions ETF or the index, the Selective US Dividend Elite Index. You can see its performance versus the S&P 500 going back to 2006. Modest outperformance of about 40 basis points. It's interesting to note that because of the dividend focus of these ETFs here with SMEP, you can look on the website for the holdings, but it does have a very light technology weighting. That's not intentional. It's just, obviously the large tech firms don't have a dividend focus. So if you're looking for a diversification tool, this isn't a comment on technology, but a great complement to a core S&P 500 ETF would be SMBP, given its low tech weighting. And once again, here on the gold line, you can see the long-term impact of adding the modest leverage would have. So for more information on our champions ETFs, I'd ask you to go to our website. We wrote what we call a playbook that highlights the methodology of both of these indices and also highlights the excellent risk metrics that they have, including lower volatility and much lower drawdowns versus the S&P 500 and the TSX. So on this next slide, very quickly, we're about to hand things over to Ed. I wanted to highlight our latest launch. Ed will talk a little bit about gold, but here we're continuing with our tradition of innovation. We recently launched what we like to call a better all-in-one ETF. This is really built for the long-term buy and hold investor. So it's called the Hamilton Enhanced Mixed Asset ETF. The ticker is MIX, M-I-X. It's an innovative all-in-one ETF that combines 60% exposure to stocks, US stocks, 20% US government bonds, and 20% gold allocation, and then applies modest leverage of 25% to enhance the long-term growth potential. So essentially what you have here is what we like to think it's a modern day balance fund to deliver long-term growth by combining three complementary, but also importantly, three asset classes that have relatively low correlation. So that's the key to this product. And as we'll show you on the next slide, this mix of 60% stocks, 20% bonds, and 20% gold has historically shown very good long-term risk-adjusted returns when compared to just owning equities outright. So here you can see the index, the Solactive index that we built with Solactive, the Solactive Hamilton Mixed Asset Index ETF. And you can see the returns in the gray bar, and you'll see that the returns are near identical without leverage. But then you add the leverage component, obviously takes you to much higher return. But the key to this really is looking on the bottom left and right. You'll see significantly lower volatility in terms of standard deviation versus owning the S&P 500. So near half of it when before adding leverage, and then still significantly less when you add the leverage, and also significantly better max drawdowns, you'll see. So we think this is a great all-in-one buy and hold new modern day balance fund that warrants your attention for sure. And we've written lots of materials on our website, so including an index methodology, the benefits of adding gold to a portfolio, and talking about these three asset classes and their low correlation. So I'd encourage you to take a look at that. So speaking of buying for the long term and owning something that's adaptable for changing market conditions, I wanted to move on to our main event here and talk to our good friend Ed to help us make sense of what's going on. For those who don't know Ed, he's the president of Yardeni Research, which we have been long-term followers of, and I'd highly encourage those listening today to sign up for his research at yardeni.quicktakes.com. There's even a free trial that you can participate in, and then a paid membership option that you can look at as well. And then he also offers more extensive morning briefings that I also get every morning, and which is very extensive and extremely helpful. On top of that, Ed is a well-known movie buff. So on top of that, he provides some regular movie recommendations that are also quite good. I can say it has saved me a lot of time aimlessly scrolling through Netflix. So I just sometimes pop into his research and look for his movie recommendations, which are quite good. So Ed, welcome back.
Thank you, Pat.
Yeah, the last time we chatted was April 8th, ironically, which was the bottom of the latest correction following the tariff announcements. And obviously we've had a massive rally since then. So if we have a big pop today, I think everyone can thank Ed. He seems to be good luck. But Ed, so just 2 months ago, markets were gripped by the tariff announcements.
Right.
We've had a V-shaped recovery. What's changed, and why do you think sentiment has rebounded so quickly? And do you agree with this shift?
Well, actually, on April 7th, it was, I think, a Monday, we wrote that the Liberation Day tariffs obviously caused a great deal of angst in the stock market, and that the April 2nd Liberation Day. And April 2nd, it was at the Rose Garden at 4 p.m., so it was after the market closed. So the markets really got trashed on the 3rd and the 4th. And title of that piece was called Annihilation Days. So I basically said Liberation Day has been followed by Annihilation Days. And I concluded that the Trump administration would most likely be forced to postpone these tariffs, and that there could very well be a V-shaped recovery. I didn't think that it would actually make the low on April 8th, and that we'd have that V-shaped recovery start on April 9th. But it was quite obvious on April 9th that things had changed when the market was up almost 10% on the S&P 500. I think that was the first time that the markets realized that they were powerful enough to change policy course. Trump made it clear, he said outright, that the reason that he postponed for 90 days the reciprocal tariff ID is because the bond market reacted very poorly to that ID. As a matter of fact, in early April, the bond yield surged from 4% to 4.5%, and that really spooked the administration. They were pretty cavalier about the stock market going down and argued that it was time for Main Street to enjoy some better times, even if that meant worse times on Wall Street. But when the bond yield soared like that, they panicked. And so my friends, the bond vigilantes, I came up with that term back in July of 1983. The bond vigilantes made it very clear that they can't have an influence on the policymaking of the administration. And then in early May, the administration also blinked with regards to the tariffs on China. That doesn't mean that we still don't have an issue. We clearly have now a 50% tariff on steel and aluminum and autos. I think that's still 25%. And these negotiations are still ongoing. But we felt that the administration would increasingly feel compelled to get this issue behind them going into the summer. They can't really afford to have this cause a recession in the second half of the year that could linger into the first half of the year. That could really cost them their majority in Congress. The Republicans have a majority right now in the House and in the Senate. It's extremely narrow, and they could easily lose it if they don't succeed in making things better rather than worse. We also thought that there'd be some court cases that would challenge the constitutionality of what the administration had done. They basically declared that the trade deficit was a national emergency that they had to respond to. I think they also threw in fentanyl, which clearly is a national emergency, but that could have been addressed directly with China. But at any event, a lower court ruled that, in fact, the administration overreached with moving with these tariffs. And then an appeals court said, well, hold off, let's stay that decision and think about it some more. And it may very well go up to the Supreme Court. But the constitutionality of the administration taking on so much power with regards to tariffs that have so much impact on so many areas of our economy and, of course, the global economy, that the courts may still weigh in on that, and it may turn out that the administration overreached. But I think either way, they want to get it over with. They want to get it behind them, and I think Trump will declare victory by the end of the summer. He'll have, I think, well, by July 9th is when the postponed tariffs presumably get activated again, and I think a lot of the major players, the major partners of the United States in trade will deliver a 5-page framework agreement, kind of like what the Brits did with the U.S. And the administration will say, that's fine, now let's negotiate that for a while. You can't possibly negotiate a treaty in 90 days. So it's all going to have to be sort of letters of agreement to negotiate some more. And I think administration will put it behind us. I think the stock market's already discounted that this issue will be behind us. And I think the stock market's starting to focus on 2026 increasingly. The market does look at earnings on a time-weighted average basis, and as time passes, as we pass through 2025, we're giving more weight to 2026. And I think the market's pretty optimistic, as I am, that the economy will continue to flourish, remain resilient, will not have a recession, and that the consumer will spend and the capital spending will remain resilient. If that's the case, and that explains why we've seen this V-shaped recovery. I did start out the year with 7,000 as my goal for the S&P 500.
Right.
Lowered that down to 6,000 in late March. Then once Trump Day, we raised it back to 6,500. I'm going to stay with that. I'd be happy to see it up to 7,000. We're using 7,000 now next year. It's all going to be a matter of valuation. I think earnings will be all right. Question is, how much higher can valuation go? Because it's already back to being really quite high.
Okay, so you raised your target for the S&P to 6,500. You went over a bit on the rationale. Can you talk about things that might derail all of this?
Well, I've written a few times along the way here that I reserve the right to change my mind as often as the president. I wouldn't have much credibility as a strategist if I did that. The president can do whatever he likes because at the end of the day, he's the president, and if he changes his mind daily, it creates a lot of turmoil for the rest of us. But he's the president, so I haven't changed my mind as often as he has. But clearly, I've had to respond to my perception and consensus perception of just what he intends to do, and how much of this is just negotiating, and how much of it is really a firm stance with regards to trying to raise revenues for the government. They do need revenues to justify their tax cuts. So I think the 10% revenue enhancer, the 10% tariff, I think that sticks with us. As we can see, the negotiations with China aren't going very well. As a matter of fact, they've admitted they aren't going anywhere, and they're particularly concerned about rare earth. And the Chinese are demonstrating that at the end of the day, they have a lot of power when it comes to supply chain, recognizing that on the other hand, we have a lot of power when it comes to jobs in manufacturing in China. So there seems to be a kind of a stall here in where we are in the negotiations with China. And that could have unintended negative consequences if there is no deal. We still need to get deals with formal deals with Japan and South Korea and Vietnam, but maybe the big one is going to be with the European Union. And we saw just a few days ago that the president was very frustrated with the lack of progress with the European Union. The European Union came back and said, well, wait a second, you gave us until July 9th to come up with something that we can both live with. So that's still ongoing negotiations. But I'd say the obvious answer to your question in terms of what could go wrong is Trump could hunker down and be tougher with these tariffs. It's unfortunate that Wall Street has embraced this taco ID. Trump always chickens out because when the president heard that, I think that really got him upset. And so he might overreact now the other way and show that he's not going to chicken out and he's not going to blink. And so the tariff issues is still out there. Just because I think it'll be behind us by the end of the summer doesn't mean that I'm right. I could be wrong on that issue.
You wrote an interesting piece one day. It was maybe a month ago. It was a synopsis of President Trump's book. I think it's The Art of the Deal. Is that what it's called? And you were talking about how it's very similar to this, like it's basically a playbook for what's happening right now. I thought that was really interesting.
Well, the fact is that Trump's background is he's a commercial real estate developer and a residential real estate developer in New York City. He's had some successes and he's had some failures. But what he learned from that experience is the so-called art of the deal. And he's had to deal with a lot of contractors. He's had to deal with labor unions. He's had to deal with politicians. And when you negotiate like that with those kind of people in the room, there's a lot of blustering going on, a lot of shouting, a lot of threatening, a lot of bullying. And then after a few days of all this, or maybe weeks of this, an agreement, a deal is reached, and suddenly everybody's buddy and you know shaking hands and claiming that everybody got what they want. And so the thing is that most of us aren't privy to those kind of negotiations, which can be pretty ugly, I presume, to be in the room and listen to all that. Now that Trump is out in the public arena, unfortunately, we're getting to hear all of that blustering and bullying in public and on a regular basis. And there's a lot of negotiating going on and changing of positions along the way. And so that makes it not a pretty thing to watch. But at the end of the day, it's all about getting a deal. And at the end of the day, I think Trump doesn't want to lose the power he has between now and the midterm elections in the last 2 years of his administration. I mean, Democrats have threatened that if they get back into power in Congress, they're going to impeach him again. So, we don't want to go through all that again, but
Sure.
who knows?
Okay, well, why don't we shift gears a bit? In some of your recent writings, you've talked about the bond market being one of the elephants in the room. You've warned about the risks of rising deficits. Do you think that the U.S. could have a trust moment similar to what you saw in the U.K., where investors are pushing back given unsustainable debt levels?
Yeah, it's possible, and I think that was a more credible concern only a few weeks ago when the bond yield got to 4.5%. It was certainly a concern when we saw the bond yield in early April go from 4 to 4.5%. And it was pretty clear that the bond market was concerned about a credit event because of the radical change that was going on in the in the marketplace with regards to the Trump tariffs. And so I think that's still a concern, but now we've seen that as inflation has remained surprisingly low so far, and it may actually continue to do that, as we've seen that real economic activity seems to be slowing, at least in some of the recent indicators. We're back down to under 4.4%. That kind of has calmed everybody down. Look, we could have another debt crisis. We had an example of that in 2023. In 2023, the bond yield went from 4% to 5% in 3 months. It was August, September, October. Let's do that again and get the months right here. August, September, and October. But then on November 1st, Janet Yellen, the Treasury Secretary, very cleverly told the bond vigilantes, well, if that's the way you feel about it and you don't like my bonds and notes, I won't issue any more than I have been. And the extra deficit that I need to finance, I'll finance in the bill market, which is exactly what she did. And that brought the bond yield down rather substantially. It didn't take much to convince bond investors that maybe 5% was a pretty good yield. We could get back up to 5%, and the Treasury could do the same thing, say that they're going to issue even more bills. Look, in an extreme condition, if the bond market doesn't want to buy any U.S. bonds, which is inconceivable, Bessent just can say, okay, I'll issue everything in bills. And if he issues everything in bills, since the Fed is targeting the Fed funds rate, the Fed will have to buy all those bills. The only question is, what Fed funds rate are they going to set to do all that? So there are games that the Treasury and the Fed can play to keep a debt crisis on a short-term basis from happening. But look, I think it would actually be a good thing if we had a short-term debt crisis that got the attention of the politicians. and now wouldn't be a bad time to have it. But look, I don't run things here. The markets run it, the politicians run it, and right now it looks as though the bond market is not having any real problems continuing to finance the debt in auctions, continuing to refinance debts in auctions. I've been doing this for a long time, and again,
Yeah.
I coined the phrase bond vigilantes in July of 1982. And I went back and reread what I wrote. And I said the bond vigilantes are very concerned about $200 billion deficits. Now we're looking at $2 to $2.5 trillion deficits by some projections. So uh, it's, uh, it's, there have been, I've got books on my shelf back here from the 80s and 90s about how debt was going to kind of bring down the U.S. economy. There's been this debt crisis talk for a long time. Some very smart and well-known people like Ray Dalio have been going around recently, past few years, warning about a debt crisis and about the government maybe stiffing us and not paying interest. I mean, that's just not going to happen.
Yeah.
The
Do
U.S.
you
government
think a
will
big
face.
part of this is part of the like yield curve control that you've written about, like the
Yeah,
Treasury doing, and that's keeping the bond vigilantes at bay? Is that?
yeah, absolutely. That's the point. Is the bond vigilantes are not the only players in the bond market. It's supply and demand, and the
Hmm.
Treasury supplies a lot of treasuries, and it can do yield curve control, as we saw um, Janet Yellen do on November 1st of 2023. She issued more of what she needed to raise in the bill market.
Mhm. Okay, well, why don't we move on to another topic that you've been writing about more than I've seen in the past year or so, which is gold. Gold's been on quite the tear with central banks that keep buying. What's driving that right now? Like, and where do you see this going forward? It's had quite a run.
Well, it's when gold rose above 2000, like every other amateur technician, I saw that it was breaking out of a kind of an ascending triangle, and it got my attention, and it became quite obvious that what was driving gold was a steady increase in buying of gold by central bankers, but particularly the central banks of of countries that we don't get along with, that don't share our values, and we're basically enemies with. We're talking about Russia, China, Iran, Venezuela. These central banks are certainly trying to diversify out of dollars and into gold and to maybe into other currencies. And that's because they saw what happened to Russia when Russia invaded Ukraine. Russia's $300 billion of foreign exchange reserves were frozen by the United States, and there's been talk about using that money to rebuild Ukraine. So uh, bad actors from an American perspective are buying gold. But I think gold is turning out to also be a hedge against chaos, political chaos, domestic, geopolitical, migration flows, the clash of civilizations between the East and the West. Uh, a lot of people are starting to feel very comfortable with gold. And maybe even some people are starting to feel uncomfortable with Bitcoin, believe it or not. I'm
Hmm.
uh, I'm not for or against Bitcoin. I think Bitcoin is kind of like digital tulips, which makes it sound like I'm against it. Um, but when I first talked about it, I realized that was actually a very bullish thing to say, because when we had the tulip mania in Amsterdam, it was a very tiny little town with how many people could buy tulips, and the market was open only during the day. And at some point, they ran out of buyers, and they went to sleep at night, woke up in the morning, and they got wiped out in the tulip bubble market. I think that what that analogy suggests. Well, wait a second. The Bitcoin market's open 24 by 7, and the reality is that there's a whole world of people who haven't even bought Bitcoin. So it potentially is very bullish, but there is the technological issue that as technology becomes more and more sophisticated, one has to consider the possibility of getting hacked. And so you could be a multimillionaire in the Bitcoin market and suddenly wonder, where your wallet went. Whereas gold, I think, has a more physical presence. and more security along those lines. So I wouldn't be surprised if at some point people actually feel safer with gold than with Bitcoin. But right now, I don't know how high Bitcoin is going to go. I'm not going to tell you it's not going to go higher.
Hmm.
And at the same time, I think that the higher Bitcoin goes, the higher gold goes as sort of a backup reserve, not just for central banks, but also for individuals. Today was the first time I'd heard about your nifty uh,
Mix.
ETF
Yeah.
and the results you're getting from it. That's quite clever. And I also want to congratulate you on your great success over the
Thank you.
past few years, and I want to take a lot of the credit for it. But
Well, you've been along with us for the whole
the whole
journey.
ride.
We definitely appreciate that, Ed, and you and your team are fantastic. Why don't we wrap things up? Like I think a lot of what we read about and see and talk about, investors are so fixated on the short term, and that's filled with pessimism and fear. But I'd like to take a step back and you highlight some of your longer term messages to investors. You've talked a lot about in the past, not so much currently about the roaring 2020s, but I think that's a great theme. Like, has your outlook changed at all
No,
in this? And it would be good for our listeners who may not have heard this to learn more about that thesis, because I do think it's
yeah.
very interesting.
Well, before I get into that, let me say that I've been doing this for 45 years and a few months along the way. And one of the things I've learned over the years is that it's amazing how well the U.S. economy performs despite Washington. It's amazing how well the stock market performs despite Washington. We get all these headlines about Washington, the Fed, fiscal policy, tariff policy, and a lot of the doom and gloomers look at what policies are doing and get very pessimistic and very bearish. And I just keep marveling at the resilience of the U.S. economy because there's all these working stiffs like me and you and others who go to work and we know what the policymakers are doing. We know that they're not helping us. They're kind of meddling in our affairs, but we deal with it, and we nevertheless are quite successful in our businesses. How else to explain that, at least in the United States, real GDP is at an all-time record high. Real consumption per household is at an all-time record high. The stock market is what, 2% away from an all-time record high. So there's a tremendous amount of resilience in the economy that you wouldn't know it by kind of reading the headlines of the newspapers and the financial press, because they do focus on a lot of pessimism, and a lot of that is grounded in controversies over policymaking. Yeah, the roaring 2020s idea is something that I started talking about in 2019. So obviously I timed it pretty well. The first half of the decade so far so good, right? It was a very despite all the problems we've had, we still managed to have a very good economy in the first half of the 2020s. I think we've had a little bit of a speed bump here with tariffs with Trump 2.0, but I think this too shall pass, and I think the second half of the decade will be a continuation of the roaring 2020s. Like the 1920s, we see tremendous technological innovations that are increasing productivity. Increasing productivity is magic. It does everything good. It boosts the output of the economy. Real GDP increases at a faster pace. It keeps inflation down. It's great for allowing wages to rise faster than prices, and it's also great for profit margins. The only downside, historically speaking, has been concerns, not reality, but concerns that it could be bad news for jobs. And of course, it is bad for some jobs, but on the other hand, it creates more jobs in other areas. And again, it means that all of us who have jobs, if we're more productive, real wages tend to go up. Wages tend to rise faster than prices. I think we're in a digital revolution right now, which kind of is consistent with all that. The digital revolution started in the 1960s with the IBM mainframes. Before that, centuries before that, we had the ag revolution, the industrial revolution. Now we've got the digital revolution. And the digital revolution is all about the processing as much data as we possibly can, as fast as possible, as cheaply as possible. And we've been very successful at doing that. And that's allowed us to get all sorts of additional productivity gains from data as a factor of production. And so from that perspective, the AI revolution isn't really revolutionary. It's really part of the evolution of the digital revolution, if you don't mind all that alliteration. But we're processing more data, and we're doing it faster. We're doing it more cheaply, and finding ways to use that to enhance technologies like humanoid robotics, which is right around the corner, autonomous driving, which is around the corner. I mean, just think what autonomous driving does to the auto industry. None of us really have to own a car anymore, or we could own it and just kind of rent it out during the day. I mean, what's the point of driving to work and having the car sitting there all day in the parking lot? What's the point of having a car sitting in the garage at night when it could be doing creating some revenues? And that's going to radically change the whole transportation industry. I think in a positive way. It is deflationary. The Chinese electric vehicle makers are now cutting their prices to the extent of 30% because there is so much competition in the electric vehicle market. So deflation isn't necessarily a bad thing. It can actually be a big booster of purchasing power.
Can you talk about maybe some of the winners and losers and all this? Obviously, we have the Mag 7 and all those related stocks
Yeah,
that did extremely well, but maybe we can look beyond that.
I would definitely stay with the Mag 7. These are
Mhm.
great companies. There's a reason why they're called the Magnificent Seven. They don't need to raise a lot of money. They don't have a lot of debt. They generated a lot of cash. They have a huge investment banking departments where they cherry pick the best technology companies, startups, and others that are out there. We've been recommending overweighting technology and communication services. We've been including, obviously, semiconductors. We've been recommending overweighting industrials because of onshoring and robotics and automation. Cheap energy in North America certainly contributes to all that. I mean, everything applies to Canada that applies to the United States. We've been recommending overweighting financials, which obviously very much applies to what you folks do for a living.
Mhm.
And we tried energy for a while, and that was a clunker. Maybe it's time to go back in. But we would stay with those three or four, if you like, for sure, even though they've come back smartly and they're not cheap, but we would definitely stay with those. And despite all the uh, excitement about moving to invest in other economies or overweighting Europe and overweighting China and other markets, we continue to recommend overweighting the U.S. As a theme. In other words, stay home is still we think will be an outperforming portfolio rather than go global. That doesn't mean you don't invest globally. Uh,
Mhm.
but it does mean that the U.S. Still has, in many ways, a lot of exceptional characteristics that everybody seemed to agree on it a few months ago, and now suddenly America's not so exceptional after all.
Yeah.
But
On that
again,
note, do you want to talk a bit about the U.S. dollar? And there's lots of calls out there for the demise of the U.S.
yeah,
dollar. And
makes no sense to me. I mean,
Mhm.
you need a big capital market to be a reserve currency. The U.S. has the biggest bond capital market for sure. Obviously, the biggest equity capital market for sure. Global investors can't just say, okay, we're not going to invest in the U.S. anymore. Maybe they are going to start to overweight other countries, but they're still going to have huge positions, necessarily so, because if you underweight the United States, you're still going to have a pretty huge position to be anywhere close to what America represents in a global portfolio. I think that the idea that the yuan or some combination of emerging market currencies could substitute for the dollar just really doesn't make much sense. I think the dollar remains the number one reserve currency. It's hard to get very excited about the economic prospects for Japan or even Europe. I know people are getting excited about the prospects for Europe, but I'd like to see a lot more movements in deregulation before I conclude that the Europeans really are reinventing their economy. Right now, it still looks like a very regulated, bureaucratic economy without a very big capital market, without a lot of entrepreneurial spirit. I hope that changes, and I hope I'm wrong about that, and that it's actually happening here. But what I do see happening because of Trump is they're going to spend more on defense. I don't know that that makes them more entrepreneurial. Maybe it will. We'll see.
Well, Ed, you're a busy guy. I could talk to you for hours, as I'm sure our listeners could too, because you're full of very useful information. So I want to thank you for your time and thank
Sure.
you for being with us along these years and being a sound mind amongst all the noise. It's very helpful. We have a lot of investment advisors on the webcast today. Is there a particular with your research? Is it quick takes that you think is a
Well,
better option for them, or?
it depends. If you like institutional level uh, research, there's our flagship product at Yardeni.com, and there's a 4-week complimentary trial of that, which includes quick takes. And if you decide that that's going to turn out to be more than you need, or it turns out when you talk to us it's pricier than you need, then you can get the product, the YardeniQuickTakes.com, which is a product that we designed for individuals, but very market oriented from a macroeconomic perspective. In other words, trying to get people to fully appreciate how macroeconomics, Fed policy, fiscal tariff policy, geopolitical developments, how they impact the market, what the market might be anticipating, what the market should be anticipating. So it's very macro, but very market oriented as well.
Yeah, we get both, and like I said earlier, we would highly encourage people to take a look at that. It's incredibly helpful. It would be incredibly helpful, just even just sound points in your client conversations as well. But Ed, we really appreciate your time.
Thank you.
We'll let you go, but have a good day, everyone, and thanks for joining us.
Thank you, everybody.